So, Sean, the market, I guess, starting to see the Fed looking towards the exits, and that's certainly been seeing a lot of upside momentum in the dollar, which is what we are following mostly in terms of market moves today. Tell us your views here on what this changes for the dollar trajectory path.
Hi, Juliette. Yeah, certainly it is a very big positive for the dollar near term. I think a lot of people in the market were positioned the way we were, really, in terms of expecting a pretty dovish note from the Fed, including Powell and the forecast. So we had thought that the underlying dollar weakness would continue, but I think we have to look to the next couple of weeks at least, and we think about all the Fed speakers who will be out there explaining the meeting and why, particularly those who did raise their projections on the dot plots for rate hikes in 2023. They'll be explaining their reasoning there, etc., and how tapering might look at it, and so on. So I think that'll put a squeeze on a lot of short dollar positions, and so we'd expect to see further dollar gains near term. Yeah. But as far as our house view, we actually haven't changed our view as far as the Fed over the next 12 to 24 months.
You mentioned how this doesn't really change your forecast right now. You're still calling for a dollar at 88.7 for the DXY. Is there more room, though, do you think, for real rates to reprice, particularly when it comes to the front end? Wouldn't that still be quite supportive for the dollar?
Yeah, so I think that's the key is how much more momentum we see. What do we see in terms of the inflation numbers in coming quarters or months and quarters? Was it really a spike that is transitory? We think the Fed in general believes that, even if it wasn't a huge focus of the commentary today. So as we get, maybe we get a bit of a tapering off on inflation. I think key as far as the policy settings, it really was that if we're looking at the Fed's inflation forecast for 2022 and 23, they're only a little above 2%. So they haven't really changed their view too much. They made a bit of a mess of their 2021 inflation forecast, so they had to sharply revise those. But they probably still taking it fairly cautiously. So for us, for the time being, we'll keep it as it is. The Jackson Hole conference, we will be interested to see if there is a bit of a change of tune around there going into the September quarterly forecast. But for the time being, we're not changing those sort of year-end targets. You mentioned the DXY below 89, but short-term, definitely, we do see US dollar support.
Sean, this more hawkish tilt certainly flowing through into EM assets. We've been watching big moves in the likes of the Korean won. Does this, I guess, make EM assets more vulnerable? What kind of move do you see to risk assets following the change in tone from the Fed?
Yeah, well, that's going to be a real key for, as you say, risk assets and risk currencies like the Aussie dollar is, can they absorb the notion of high yields? I mean, I think one thing that is working in advantage is sort of our starting points. I mean, the 10-year went into the FOMC meeting about 149, so at least it wasn't at 180. So we are a long way from recent highs in terms of US yield. So there's a lot to absorb there. As I say, we've got a lot of Fed speakers coming up. They should be mostly upbeat on the economy, but perhaps the best thing to do is just to watch the division between the likes of Powell, Clarida and Brainard versus the regional Fed presidents, who I think are the ones who probably moved in the dot plot. So but maybe there's still so much support in terms of monetary policy for risk assets around the world. So it is definitely a near-term challenge for emerging markets, but one I think they'll probably emerge from okay multi-week, multi-month.
Sean, talk us through the moves we're seeing in the Aussie bond market. The 3-year yield has been spiking on the back of this jobs data that we got, which was another blowout print. It seems like there's a speculation that the RBA is going to have to, I guess, start tapering or reduce their bond buying soon. Do you think it's going to be much tougher for them to stand pat in July now?
Yeah, well, certainly the November 2024 bond, which has become the benchmark, and that was the one that they will formally review in July as to whether their 3-year yield target transfers from April to November 24. So that one, it didn't sound from Governor Lowe today as though he's very enthusiastic about moving it yet again. So that one, you're going to understand why the yields are jumping there. But as far as QE, he went through the options there, and I suppose what was most noteworthy when they're going to consider the bond purchases at the July meeting, that he's very clearly ruled out the option of stopping QE. But as far as tapering, we think that they'll switch from a fixed $100 billion program to a $5 billion a week. So it's actually not really a change in terms of the pace of those purchases. But yeah, there's going to be a lot for the markets to absorb, and there'll be a lot of tension around that meeting. And today's jobs numbers were just enormous. It was actually the largest rise in full-time employment on record. So that's further food for thought. So you would think near term the risks are very much to the upside for Australian bond yields.
Sean, there's a line crossing here once again from China saying they're going to step up oversight of the commodities, spot and futures markets. We had the line yesterday that they were potentially planning to release some of these state reserves to cool down prices there. Do you think that's going to weigh on the Aussie in any way?
At the margin, but we actually saw the announcements on the using the reserve several weeks ago. So this is sort of confirmation that they are proceeding with that. But in the end, they're fighting with the laws of supply and demand. Really, China, we saw in their industrial production numbers, a record high for steel production. So long as they're going to keep running those factories so hard, they're going to put upward pressure on prices. And yeah, sure, it can help a little bit to release from reserves, take a little bit of the heat out of it. But big picture, so long as they've got that demand for metals, then the prices are going to remain very, very elevated, and certainly keep fair value estimates for the Aussie dollar well above 80 cents.